Okay. Okay, here's our lecture overview and above the line deductions intro. So here we are in the tax formula. We want to get gross income down as low as we can without actually giving up income. We just want to reduce reported income. And we're going to look at some deductions from gross income to get to adjusted gross income. And remember, it's important to get AGI as low as you can go because AGI is used for many phase outs for deductions and credits. So we have two types of deductions that reduce AGI. Deductions that reduce the amount of gross income reported on Form 1040 and deductions that reduce reported gross income. So reducing gross income reported on 1040. So you recall that line 10 is our total gross income and lines 1 through 5 list specific types of income. But we also can go to Schedule 1 in this top portion and list our other types of specific income. Now, some of these items are business or investment income. So look at lines 12, 17, and 18. These are business types of income. Now, to reduce reported gross income, be sure to reduce all of that income from businesses by all related expenses before you enter the income on this Schedule 1. Now look particularly at line 17. Line 17 includes partnerships, S corporations, and trusts. These are pass-through entities, and we have defined that as businesses who do not pay their own income taxes. Rather, the income is reported on the owner's tax return, and there you're going to report it on line 17. Now, they show S corporations on line 17, but not C corporations, and just remember that C corporation income is not reported on the Form 1040. C corporations pay their own income taxes. Now, be sure and deduct all ordinary, necessary, and reasonable expenses. So this seems obvious, but people don't always do it. Number one, keep good records. Clients tend to underestimate rather than overestimate expenses. 2, be sure and allocate personal expenses to business use when possible. The portion of the car that's used for business, portion of the housing expenses used for business, portion of travel used for business. There are some limits on that. And number 3, get a good bookkeeper and CPA because that will actually save you a lot of money. I am convinced of that. Many people hate to pay for that, and it would save them so much money. Now remember that business owners are not employees, so certain expenses related to the owners are not deducted as business expenses. For example, fringe benefits for owners are not deducted from Schedule 1 income. So contributions to the employer-sponsored retirement plans and health coverage benefits, they are not deducted from business income. Even if the employer has an employer-sponsored retirement plan, the employer deducts the employee contributions that the employer makes, but not his or her own. Okay, and 2, self-employment taxes cannot be deducted from Schedule 1 income. Okay, trade or business expenses. Daenerys Targaryen has a business that provides dragon services. Her revenues are $100,000. Her business expenses are employee wages $40,000, veterinarian $10,000, payroll taxes $30,060, employee health insurance $16,940. Her total expenses are $70,000, so $30,000 will be shown on the Form 1040 as income. Now I want you to remember this $30,000, which is her profit shown on the income, and I want you to remember this payroll tax amount of $33,060. Now remember, contributions to her own retirement plan and health coverage expenses are not deductible as business expenses. So reduce gross income, and here's these 3 tips that we just went over a moment ago. So deductions from gross income to get to adjusted gross income. So recall on page 2 of the Form 1040, line 7 is adjusted gross income. And we had to go to Schedule 1, the lower portion, lists those adjustments to gross income. So they're listed there. So you may want to read them. So first we're going to talk about self-employed deductions from gross income. Lines 27, 28, and 29. The deductible part of self-employment tax, self-employed SEP simple and qualified plans, and self-employed health insurance deduction. Okay, so she can deduct those things, but not against business income. Okay, so what is this self-employment tax? It's the equivalent of Social Security and Medicare taxes for self-employed persons. So Social Security and Medicare taxes review. Remember that Social Security and Medicare taxes, FICA taxes, are withheld from employee paychecks. Social Security and Medicare is withheld at a rate of 7.65 up to the Social Security wage base, 1.45% beyond the wage base. The employer has to match the withholding and send the total to the Treasury. So as we just saw, she had a total payroll of $40,000, so she withheld $3,060 from those paychecks for FICA taxes. She had to match the $3,060, so she sent $6,120 to the Treasury for FICA taxes. So $3,060 was paid by the employees. That was withheld from their paychecks. But the other $3,060 was a direct expense in addition to wage expense to Daenerys. Now that was deducted from her own business income. And her total profit to be reported was $30,000. So she will have to pay self-employment tax on her $30,000 profit. It includes both halves of the FICA taxes, and it's calculated as $30,000 times 7.65% times 2, but you then multiply by 92.35%, so that knocks it down a little bit. Now, she can't deduct this from reported profits, but she can deduct half of it for AGI, so she gets a deduction. What's the significance? What's the difference, really, if she can deduct half of it for AGI? Would that be any different from deducting half of it from business income? Well, yes, it would. If she could deduct it from business income, it would actually decrease the self-employment tax, but that's not the way it works. Okay, so she'll have a deduction of half of the self-employment tax for AGI, or $2,119.48. Now, she has a low profit here, but of course, if her income had been over that Social Security threshold, she would adjust her Social Security calculation to limit that Social Security portion of the self-employment tax. So over the threshold, she would have just had to pay the Medicare portion. Okay, and a Medicare surtax on self-employment income. So there's a Medicare surtax on a high-income wage earner. She's not a wage earner, but there's Medicare surtax. The self-employed are also subject to this tax. Now, it's not part of the self-employment tax officially. It's not included in the deduction for AGI that we're discussing here. So be sure to take all above the line business and other deductions to get AGI as low as possible. Now let's talk about student loan interest. You can take only up to $2,500 a year. So, you hear this often that student loan interest is deductible. So let's see, how deductible is it? You can deduct up to $2,500 a year. That's all. The taxpayer has to have the primary obligation to repay the debt. So, if the loan is taken out by the parent, in order to have any deductibility, it has to be paid by the parent. If the student takes over the loan, no deduction. If the student takes out the loan, the student has to pay the loan to get the interest deduction. If the parents pay it for the student, no deduction. Okay. But there's also a limit to how much you can deduct based on your AGI or MAGI. Now, recall, for this course, you don't need to know how AGI is adjusted to get MAGI. So just use AGI unless the problem gives you your modified adjusted gross income. So here we have 2018 and 2019 phase out ranges, and you can see it differs by filing status, and these numbers are indexed. They change a little bit every year. And these numbers are your adjusted gross income. So here we've got Amy and John. They are married filing joint for 2018. John has student loan interest of $4,000. The MAGI for 2018 is $155,000. How much is their student loan interest deduction? Okay, so they are married filing joint. You can see that it phases out between 135 and 165 of AGI. So how do you do this calculation? You take their MAGI of $155,000 minus $135,000 to get $20,000. Now this 20,000 is then divided by the range spread. And what is the range spread? Look at married filing joint. The phase-out range is between 135 and 165. So the range spread is the $30,000 range in there. So you take your $20,000 divided by $30,000. That gives you 0.667. You take $2,500 times 0.667. And so 1,667 is phased out. So then you take your 2,500 minus 1,667 equals 833, and only $833 is deductible out of the 4,000 that they paid. So it's deductible, but for many people it's not a great deduction. Another example, Emilio and Joanne are married filing joint for 2018. Emilio has student loan interest of $4,000. Their MAGI is $170,000. How much is their student loan interest deduction? Nothing. They're over the limit. They get no interest deduction for that at all for the $4,000 student loan interest they paid. Ahmed and Zainab are married filing joint for 2018. Zainab has student loan interest of $1,000. Again, their MAGI for 2018 is $155,000. How much is their student loan deduction? Okay, so you go through the same calculations and you get 0.667. But here you take 1,000 times 0.667 equals $667 is phased out, so only $333 is deductible for this couple. So use deductions and exemptions to your best advantage. The person who takes out the student loan should be the person who is most likely to be able to get a student loan interest deduction. So, but that doesn't always work out. So here's an example of something else you can do. If a student takes out the loan and the parent wants to make the payment for the loan, which happens frequently, then the parent should gift the money to the student and let the student make the payment to get the tax deduction. So that if the student took out the loan, the student is paying the loan. It doesn't say that nobody can give any money to the student. So just make sure that they do give the money to the loan to their child, assuming the child will actually use it to pay the student loan. Okay, let's talk about health savings accounts. These have to be used with high deductible plans. And I'm not showing you here Schedule 1, but these health savings account contributions are shown as one of the deductions from gross income to get AGI. So they have to be used with high deductible plans. Now, what is a deductible? It's the amount that the insured has to pay during the year before the insurance starts to pay. So, for example, John has $5,000 medical bills in February. His deductible is $2,000. He will pay $2,000, his deductible, and the insurance company will pay for the $3,000. John has $10,000 medical bill in June, so the insurance company will pay all of it because John has met his deductible. So we've got deductibles for health insurance, so don't confuse this with a tax deduction. It's not a tax deduction. Now these health savings accounts have to be used in conjunction with high deductible plans. So we're not going over the numbers here, but you can look in the textbook and see how high the high deductible is, what the number is. Now, an HSA tax deduction is taken for contributions, not medical expenses. So the taxpayer can take a deduction for the contribution even with no medical expenses. So what happens to that money when they put it in a health savings account? The fund is now in a tax deferred account. Does this remind you of retirement accounts? It should. So if you withdraw the funds for qualified medical expenses, the funds aren't taxed. So that means that you have money that will never be taxed. So that's really exciting. And the income used for the contributions and the growth in the account are tax-free. So any money in there grows, it's invested, it grows, and it's tax-free. So this is really good. Now, you can always get at your money, but if funds are withdrawn for non-qualified medical use, the funds are taxable, and there's also a 20% penalty. So don't put money in there that you might very well need for other things, and you have to go back and withdraw it. But here's something that's really important. The funds in the HSA, they don't have to be used. A person can let the amount build up in the account, either because you're very healthy or because the person maybe can pay for medical expenses out of other funds. So many high-income taxpayers, they have enough money to contribute to an HSA and yet pay for their out-of-pocket medical from other funds, and they won't withdraw anything from the HSA. Now, why do this? The penalty for this non-qualified medical use stops at age 65. So once your clients hit age 65, they can get at that money with no penalty. And there are no income phase outs for HSAs. So HSAs can be used like an IRA to generate tax-deferred investments. So, for example, Russell and Lynette are a high-income couple covered by a high-deductible health care plan. They're phased out of making a Roth contribution. They're phased out of making a deductible IRA contribution. They make the max contribution to their HSA each year, and they can still get a tax deduction. Now, they can let that money grow and grow tax deferred. They pay for medical expenses out of other funds. And so when they're 65, they're eligible to take distributions from the HSA for any reason without penalty. So this is just like an IRA. So when they withdraw the funds, they do pay income tax on it. That's like an IRA too, but they don't pay the penalty. So the HSA has effectively been used as a tax-deferred retirement savings vehicle for this high-income couple. So take advantage of HSAs to get a deduction for contributions and tax-free income when using distributions for qualified medical expenses. So if they're not currently covered by a high-deductible plan, consider moving to one to take advantage of these HSAs.